Last week, you were the first major strategist to lower your S&P 500 price target. You cut your year-end forecast to 6,200 from 6,500. Just tell me, first off, what's behind the call, and are you worried about a slowdown in earnings?
Well, the genesis for why we reduced our year-end target is really a function of greater uncertainty and a slowdown in economic activity. Those are two key inputs into our earnings model, and that's also a component of our valuation model. So the bottom line is we're looking for earnings growth in calendar 2025 of plus 7% and 7% growth in 2026. So 2 years of about 7% growth. Previously, we had anticipated around 9% growth this year, and the key driver behind that is a slower economic forecast for the U.S. economic output, and as a result, we have a lower year-end target around 6,200. So it's a similar kind of return as we anticipated before, but just from a lower level. And obviously recognize that that's a challenging situation because the tariff assumptions we're making, we're now assuming that the tariff rate is going to increase by around 10 percentage points. It's consistent with our colleagues in U.S. economics research. And so the tariff rate, Matt, in the coming year will be around 13% in our model. Previously, we had assumed around 3%. So those are really the three building blocks: the slower earnings growth, largely driven by slower economic activity and a higher tariff rate, and then a slightly lower PE multiple ascribed to the year-end growth for next year.
You know, David, the sentiment out there is brutal, and you see it in some of the big tech stocks. The Magnificent Seven today is down, getting close to 3% just today alone. You have started calling this the Maleficent Seven. Is that how you say it? Maleficent,
that's
Maleficent
right, I
Seven.
think.
Maleficent.
Yeah. Maleficent Seven. And, you know, what can happen to turn that around, if anything? What are the broader market implications for sentiment and what has been the darling sector in the market to turn so low?
Well, I think the proper way to think about this is that the extraordinary returns for the U.S. equity market over the last 2 years has really been driven to a meaningful amount by the 7 large companies that go by the sobriquet, the Magnificent Seven. Unfortunately, from a portfolio management perspective, it's been Maleficent Seven. It's been the real source of pain in the market this year. And without those companies, which are down roughly 12% year to date, the rest of the market is actually up. The 493 remaining stocks are up around 1% year to date. So it gives you some context around the importance, the influence that these companies have had on the broader market. The idea of these companies, the uncertainty around some of the regulatory environment, the source of when the hedge fund community in particular, which is largely invested, tilting their portfolios towards these companies, that's been a source of selling. On the other hand, about 60% of large cap mutual funds are actually outperforming their benchmarks because they've historically or traditionally been underweight these stocks. So it has had differing implications for different groups of the clients of Goldman Sachs. And it's an important way to think about our outlook for this year is the idea of a broadening of the market. That's been central to our forecast and outlook for investment strategy for 2025. The idea that a broadening of the market is likely to take place, and that has been a little bit consistent with what we were anticipating. The idea of keep going, Matt.
Well, I was just going to say, broadening, that sounds great, and hope you're right about it. But there's still got to be some leadership, right? And if it's not the Magnificent or Maleficent Seven, NVIDIA right now leading declines as the NASDAQ 100 falls almost 2%. Who takes over? Who does the heavy lifting here in a rebound?
Well, the point you identified correctly is that about a third of the market cap of the S&P 500 are these seven companies. So clearly they have a disproportionate impact. 7 companies, more than 30% of the index. You can get a broadening of the market in other ways, which is a greater uplift in the typical stock. You can see that in healthcare companies. They've actually done pretty well. You've had some defensives generally done well. This is an area we've been focusing on with respect to discussions with fund managers of how to position their portfolios in this market. Specifically, what we're looking for is what are the 3 drivers of the market that have been afflicting the companies this year has been a question about where we are in the AI transition. And we've gone, obviously, NVIDIA, a terrific story, terrific company from a stock point of view, was really an extraordinary driver of performance in the last couple of years. Obviously, that's moved a little bit in the other direction. Well, that is sort of phase one of what we think of as the AI transition. Phase two, which is the infrastructure, where a lot of the hyperscalers are located in that sort of category. Utility companies, really companies that are involved in the build out of the infrastructure for AI. And really the focus of fund managers now has shifted to the third phase, which is the applications. A lot of the software companies, stocks down dramatically last year. They've actually been an area of focus for
David,
portfolio managers. So now that's where we're focused.
One issue, I think, for portfolio managers, and what you're saying, actually, there's a silver lining in that. If you have mutual funds finally outperforming because you have a broadening of the market, that's actually great for your retirement account because of the diversification many FAs, financial advisors, have on. But a lot of the trades this year that have done well are really, really defensive. And even then, at this moment, people are having a really hard time buying the dip. So what is your advice? What are you telling clients who are looking to take advantage of the fact that the market has fallen so much when they don't know what the low is?
First of all, Sonali, we have to put this in context. In any year, the typical drawdown is 10%. In any year, you typically get a peak to trough drawdown at some point of 10%. Well, that's what we've got. So it's not so extraordinary, and it's largely driven by some of these biggest companies we just been speaking about. Absent that, the typical stock is down maybe 5%. So where are we focused? We're focused on a couple of things. Number one, what are some stocks that are insensitive to some of the drivers of the market, some of the idea of economic activity, the idea of it potentially slowing down, the idea of concerns about the return on capital that so much of the AI story has been based upon. Well, there are companies where their trading in the last 6 months have really been less sensitive to regulatory environment, uncertainty around the economy. Amdocs, MSCI, you can think of companies in a lot of healthcare companies there. They have traded in a pattern that has been unrelated to some of the key drawdown sources, which has been a reassessment of how fast the economy will grow, focus on the AI. So there's a bunch of companies we call our insensitive portfolio, stocks that have not displayed price sensitivity to some of these bigger themes that have been buffeting the market in the last several months. So that's a strategy to be thinking about for this environment. For those portfolio managers who are consistent with our view, which is the economy is still growing, the market is going to end the market, likely to end the market, the year higher than it is today, 6,200. There are some stocks that are really not so sensitive to what's been happening in the day-to-day news flow.
We'll look to the insensitive portfolio. In the meanwhile, when you cut your S&P target, you raised your target on Europe's stock 600, or the outlook at least there. Are you saying this is like the go-to trade? Because it certainly has been working.
It certainly has been working. And that question really relates to what's the longer-term investment strategy. And we've been focusing for a while on the U.S. exceptionalism story and the idea that U.S. companies have a dramatically higher reinvestment rate of their cash flow. To give you an example, for the last decade, on average, U.S. companies reinvest around 40% of their cash flow back into their business to grow the business, whereas the rest of the world, stock markets, it's around 25%. That's a pretty meaningful gap, and that gap can persist year after year after year. So the idea of companies, U.S. companies, investing for the longer term is something that's unique characteristic of U.S. companies. That's one area why, from a longer term perspective, U.S. stocks likely to continue to do better. They've obviously been a source of awesome performance for the last 15 years. The valuation has come down slightly. But the earnings growth still in the United States of 7%, Matt, is going to be much greater than you're getting in Europe. Europe's really had a valuation recovery off of a low. But it's still, U.S. companies will have faster growth, and admittedly they trade at a higher multiple, and they're also investing more to have that growth persist.